for the delivery business. Our man George Tsilis taking a look at the numbers, trading at $293 right now. George, FedEx highest since the last earnings, which also had extreme volatility. What is it about this company, firstly, that just lends itself to this binary nature of earnings where it either crashes or soars? I mean, is there that much uncertainty about the business model right now?
Well, I think, obviously this is a global company, so I think that speaks to some of the challenges they face from visibility. Currency risk is also something you got to consider with 70% of their sales really overseas in their international business. And I think the cyclicality of the business also is really kind of speaks to the challenges they have. But this is a company that's very dynamic. So, quarter over quarter, you'll see expenses rise and then sales will catch up next quarter. So there's a lot of variability between, sales quarters and expense quarters. And this quarter is not one of sales growth because if you look at the print, they came in just slightly above the estimates at $22.10 billion, just beating the estimate at 22.05 by a fraction. The sales were only higher by less than 1%, 0.9% to the upside. But if you look at the EPS growth for the quarter, 8.5% to the upside, coming in at $5.41, beating the 5.38 estimate. So what gives? Essentially, the aspect of what FedEx is doing, and this is something they talked about last quarter, is their cost-saving initiatives. They're deploying a lot of cost-saving initiatives to mitigate operating expenses. And in fact, they have a target of reducing their operating expenses in 2025 by $2.2 billion. So if you look at their operating expenses last year, around $12.5 billion, that's about 17% decrease. And with that said, this is the reason I think they're on target to do so. If you look at the EPS guidance they provided, the range before was 17.25 to 18.25, OJ, and they raised it to 18.25 to 20.25. So I think the EPS guidance revision to the upside speaks to obviously a couple of things. They're redeploying that cost savings into capital allocation, and they're basically buying back additional shares next quarter, $1 billion. They're now authorizing another $5 billion share buyback. And if you just do the numbers, looking at the $63 billion market cap, that's a significant portion. That's about an 8%. Share buyback authorization into fiscal year 2025. So, looking at the price action, I think now we may be over 10% if my math serves me correctly, but you have to consider a large portion of that is the share buyback.
Okay. All right. So that's a pretty big deal. I mean, I guess at least putting the confidence out, putting their foot out in front and buying back shares is at least signaling confidence. The outlook shifting a little bit higher while CapEx shifts down to a tiny bit relative to expectations. Maybe the market didn't like how much they were spending.
That's it. I mean, that's the moral of the story. This is going back to last quarter, even 2 quarters ago. This company had a goal to reduce expenditures. And so the aspects of the price move we've seen, and the stock has held up, irrespective of today's post-market move. The stock was higher by 8% or so in this last year. It's not necessarily because sales growth is expanding. In fact, if you look at their guidance, they reaffirmed their sales guidance at the low to mid-single digits. So, you're seeing a pretty, I would say, pretty substantial. Maybe substantial is a little bit of a large word here, but a pretty generous increase in EPS estimate growth. Again, from 17.25 on the low end to 18.25, all the way up to 20.25. So the EPS raise is higher, significantly higher as a percent on a percent basis than the sales guidance, which was relatively reaffirmed. So my point is really nice move in the after hours, but to me, this is indicative of a capital structure reallocation. In other words, the cost-saving initiatives are being bypassed into share buybacks, and that's great for shareholders. But endogenously speaking, it still says to me that FedEx is not growing its top line like it was, at least on a 5-year average, which was between 5 and 6%. We're looking at basically low 1% range.
Got it. Okay. And that's kind of where the rubber meets the road, is there's just not a lot here for growth. But that's where the buyback comes in. That's where the profitability outlook comes in. So I think that's kind of where maybe the street had already had the lines drawn, where they knew it was going to be weak in terms of growth. The question is if they were going to be able to make managerial financial decisions to try and reward investors for sticking around. So the buyback, an outlook for profitability, and you get a big move here that kind of puts to bed some of the deeper concerns, I guess, of a major breakdown in the financials.
Correct. I mean, that's the thing. This is really a financial, kind of structure move. I call it that because just looking, like I said, the sales growth, they just reaffirmed it. So it's great for shareholders, and we talk about this all the time, ideally speaking. And like I said, that $5 billion share buyback authorization is quite a rich buyback. I mean, 8% of the float will essentially move the stock at least that. Plus, again, a fractional move higher based upon maybe some adjustments. Slight adjustments, maybe in some expenses that will probably recognize when they have their conference call.
Okay. All right. George Tsilis, good stuff. Appreciate that, GT. Nice look at FedEx here.
Okay, OJ.
Good explanation for a big rally.